Usually when you look at a corporate earnings report, there is this expectation of like diagnostic precision.
Right, like a blood test.
Exactly. It's supposed to be like a blood test. You read the top line revenue, you check the bottom line earnings, and the market points to the results and just declares the patient either healthy or sick.
Yeah, it's usually very binary.
Green or red, beat or miss. You make a snap judgment, adjust your portfolio, and you move on.
But if you step into the world of healthcare supply chains and pharmaceutical distribution, that simple blood test turns into like a 10,000-page medical chart.
Oh, absolutely.
And it's written in this dialect of corporate finance that actively resists quick conclusions.
Yeah.
I mean, when you are analyzing a company that touches roughly 1/3 of all pharmaceuticals in North America,
which is just a wild statistic.
Well, you aren't just taking the temperature of a single corporation at that point. You are analyzing the vital signs, the arterial flow, and really the structural integrity of the entire North American healthcare ecosystem.
Which perfectly brings us to our mission for today's deep dive. We are taking the Q4 fiscal 2026 earnings call transcript for McKesson Corporation.
Ticker symbol MCK.
Ticker M-CK, yes. And we are adopting a relentless, data-forward, highly actionable approach here. Because the goal is to strip away all that Wall Street jargon, the polished executive summaries, and the standard corporate hedging.
Get right to the nuts and bolts.
Exactly. We are going to look at the hard numbers, interrogate the story management is trying to tell about those numbers, and deliver a definitive verdict on what this actually means for your capital.
Yeah, because whether you are holding this stock, considering it as a defensive play, or honestly just trying to understand where the healthcare sector is bleeding cash versus printing it, you need the underlying mechanics, not just the headlines.
Right, because the edge for a retail investor doesn't come from knowing the revenue beat expectations by, 2%.
No, not at all. The edge comes from understanding the operational leverage required to process $400 billion in physical goods.
Which is just a staggering amount of volume.
It is. And understanding the mechanics of spinning out a slow growth division to a private equity firm, or the capital structure math behind a multi-billion-dollar share buyback funded by debt.
Yeah.
I mean, that is where the actual narrative lives.
Okay, well, let's start with the sheer scale of those headline numbers, because the Q4 and full year results for fiscal 2026, they require a moment of recalibration.
They really do.
So for the fourth quarter alone, revenue hit $96.3 billion.
It's just massive.
Right, and that is a 6% increase year over year. Adjusted earnings per share, the EPS, came in at $11.69, which is a 16% jump.
Yeah.
But then, you pull the lens back to the full year, and the numbers become almost difficult to conceptualize. Total revenues crossed the $403 billion mark.
A 12% increase.
12%, yeah. And adjusted EPS grew 18% to $39.11.
And actually, if you strip out the venture gains they had from the previous year to get a true apples-to-apples operational view, that adjusted EPS actually grew by 20%.
Okay, so a 12% revenue growth versus a 20% core operational earnings growth.
Yeah, and that contrast right there is the first critical signal in this transcript.
How so?
Well, in pharmaceutical distribution, you are operating in a notoriously low-margin, high-volume environment. Traditionally, distributors operate on what are essentially penny profits per pill.
Right. They aren't making the drugs.
Exactly. They're moving heavy, highly regulated, temperature-sensitive boxes of molecules from manufacturers to pharmacies and hospitals.
So to grow earnings nearly twice as fast as revenue at a $400 billion scale.
It indicates a massive structural shift. It shows how efficiently they are moving those boxes, or, a shift in exactly which boxes they are choosing to move.
Let's drill into that efficiency, because if your margins are razor thin, you can't just magically double your volume overnight to drive 20% earnings jump. You have to ruthlessly optimize.
You really do.
I used to think of McKesson as a glorified delivery service, like just a giant fleet of trucks.
A lot of people do.
But looking at the cash flow, they generated $6.2 billion in operating cash flow for the year and returned $5.1 billion directly to shareholders.
That doesn't sound like a trucking company.
No, it doesn't.
It sounds more like a high-frequency trading firm dealing in physical molecules.
That is actually a much better framework than the standard logistics comparisons. They operate as the central nervous system of healthcare delivery.
Right.
But to understand how a delivery service throws off $6 billion in cash, we have to look at the absolute elephant in the room regarding volume.
Oh, the GLP-1 weight loss drugs.
Exactly. The Ozempics, the Wegovy's, the Mounjaros, the transcript reveals these were a massive, almost unprecedented tailwind for them.
I mean, they are everywhere right now. Yeah, and the numbers back it up. GLP-1 distribution revenues hit $14 billion in Q4 alone. That's a 22% year-over-year increase.
$14 billion in one quarter.
Yeah, and for the full year, GLP-1s generated $53 billion, up 27%.
Okay, $53 billion from one specific drug category. But here is the data point that jumped out at me from the Q4 breakdown.
The sequential dip.
Yes. There was a 4% sequential quarter-over-quarter dip in those GLP-1 sales.
Right.
And if I am an investor holding this stock because I think it's a backdoor play on the weight loss drug boom, a sequential dip in volume looks like a massive red flag. It looks like the bubble might be losing air.
Oh, absolutely.
Yeah.
That 4% sequential dip is precisely the kind of data point that shakes out weak hands in the market.
It sounds bad.
A surface level reading definitely suggests panic. But the transcript explicitly states that this slight sequential volume dip, along with the branded pricing declines triggered by the Inflation Reduction Act, had essentially zero negative impact on their operating profit for the quarter.
Wait, okay, let's unpack this. How does the revenue of your most famous product drop sequentially and you face mandated price cuts from the federal government, yet your profit remains untouched? The math feels contradictory there.
It does feel contradictory until you unpack the specific mechanics of pharmaceutical distribution contracts.
Okay, walk me through it.
So GLP-1s are a top-line phenomenon. They are highly expensive and they move in massive physical volumes, which obviously inflates the revenue numbers astronomically.
Right, because of the price per pen.
Exactly. But for the distributor, they are notoriously low margin. These are biologics. They require strict cold chain storage.
Meaning they have to stay refrigerated.
Right. You cannot just put them on a standard wooden pallet in a regular warehouse. They need refrigerated facilities, temperature-monitored transit, specialized handling.
That sounds expensive to manage.
It is. Furthermore, the manufacturers of these blockbuster drugs hold all the pricing power.
Because everyone wants them.
Exactly. The manufacturers don't need to give McKesson a generous margin to incentivize them to move the product. Consumer demand is already pulling the product through the supply chain at breakneck speed.
So $53 billion looks incredible on the top line.
But it's highly capital intensive and yields very little bottom line profit.
So are GLP-1s essentially a loss leader for them?
I wouldn't call them a loss leader, but they are a margin diluter. They generate massive cash velocity, sure, but they actually drag down the overall profit margin percentage.
Interesting.
The real profit engine, the actual mechanism that puts that 20% EPS growth on the board and shields them from the GLP-1 sequential dip, is their specialty products division. Specifically, oncology.
Okay, let's pull the numbers on the oncology and multi-specialty segment because they are honestly staggering. Q4 revenues were up 35% to $12.7 billion.
35% is huge.
And the transcript mentions they made a couple of acquisitions recently, right? Prism Vision and Core Ventures. But it also notes that even excluding those acquisitions, the organic growth of this segment was still 13%.
And that organic growth figure is the bedrock of the bullish thesis here.
Why is that?
Because that 13% isn't coming from a sudden spike in a fad drug. It is coming from the structural expansion of their U.S. oncology network.
Okay.
They added over 570 providers to this network over the fiscal year alone. That is the largest net increase they have executed since 2010.
Wait, why does adding independent oncologists to a network drive so much profit for a drug distributor? Like, what is the actual mechanism of that relationship?
Well, when an independent community oncologist joins the U.S. oncology network, McKesson isn't just selling them drugs.
What else are they doing?
McKesson effectively becomes their operating system. They provide practice management services, revenue cycle management, group purchasing power, and specialized clinical technology.
Oh, wow. So they are deeply embedded.
Exactly. And in exchange, McKesson secures a highly predictable, incredibly sticky, and high-margin relationship.
Because the drugs used in cancer treatment are completely different from a weight loss pen.
Exactly. The drugs utilized in oncology are incredibly complex, highly specialized therapeutics. The margins on distributing, handling, and managing the inventory of, say, a personalized gene therapy or a complex biologic for cancer treatment are exponentially higher than moving a GLP-1 pen.
Right.
By embedding themselves into the day-to-day operations of these clinics, McKesson guarantees that the highest margin therapeutics in the market flow exclusively through their infrastructure.
And while they're expanding this high-margin oncology network, they are simultaneously driving down the cost of their core operations.
Yes, the efficiency plays.
Right, because the transcript highlighted a 293 basis point improvement in consolidated operating expenses as a percentage of total operating profit.
Which is a mouthful.
It is a mouthful. Let's translate 293 basis points for a second. That is essentially a near 3% improvement in their cost structure relative to their profits.
Yeah.
Now, in a grocery store, a 3% operational improvement is nice, but in a low-margin distribution business processing $400 billion in volume, how does a 3% improvement actually materialize in the warehouses?
It materializes through the aggressive deployment of artificial intelligence and robotics in environments that historically relied on massive human labor forces.
Okay.
The transcript specifically focused on their newly launched Montreal distribution center.
I saw that part.
Yeah, they have implemented these advanced storage and retrieval systems that are completely automated. But they aren't just using robots to move pallets around.
Right. It's more than just automated forklifts.
Exactly. They are using an integrated AI planning system that connects demand forecasting, supply chain constraints, inventory levels, and warehouse operations into a single real-time environment.
So instead of like a warehouse manager looking at historical data and guessing how many pallets of a specific antibiotic they need next Tuesday, the system is predicting the demand.
Yeah.
And it's automatically adjusting the order flow and literally routing the robotics to position the inventory near the loading docks before the trucks even arrive.
Precisely. They are transitioning from a reactive historical supply chain to a predictive algorithmic one.
That is wild.
And when you are managing cold chain logistics for $53 billion worth of GLP-1s, any spoilage, any delay, any misallocation of refrigerated truck space is a massive hit to the bottom line.
Because if those pens get warm, they are garbage.
Exactly. Millions of dollars gone. So that 293 basis point improvement is the financial manifestation of AI, perfectly optimizing the physical movement of temperature-sensitive molecules.
This sounds incredibly robust, but I am looking at the macroeconomic environment, and I feel like I have to challenge this narrative of invulnerability a bit.
Sure, let's play devil's advocate.
Because you have the Inflation Reduction Act actively empowering the government to negotiate down the list prices of blockbuster drugs.
Right.
And you have major pharmacy chains like Rite Aid going through bankruptcy and closing hundreds of stores, which is a direct loss of distribution points for McKesson.
Yeah, the Rite Aid situation is definitely a factor.
Right. So if the federal government is compressing the price of the product you sell and your biggest retail customers are shutting their doors, how is it possible that this company is guiding for aggressive double-digit earnings growth next year?
Well, the mechanism protecting them from those specific headwinds is perhaps the most misunderstood part of McKesson's business.
Let's hear it.
Let's take the Inflation Reduction Act first.
Yeah.
The IRA targets the list prices of branded therapeutics, right?
Yeah.
Historically, drug distributors made a portion of their margin based on a percentage of that list price. If the price goes down, the distributor's cut goes down.
Which would be catastrophic for earnings.
It would be if they hadn't spent the last 5 years renegotiating their manufacturer contracts.
Oh, really?
Yeah, they have largely transitioned to a fee-for-service model. Their compensation is increasingly tied to the specific services they provide.
Like the cold chain handling.
Exactly. Cold chain handling, inventory management, data reporting. They get paid for that rather than just a flat percentage of the drug's price.
Okay, that makes sense.
Because the physical cost and complexity of storing and shipping a negotiated drug doesn't decrease just because the government mandated a lower price. It's still the same physical box. And McKesson still gets paid for the physical and logistical labor.
Got it. So they decoupled their profit from the price of the drug and tied it to the complexity of the logistics.
Exactly. They decoupled it. And the second layer of defense against these headwinds is their prescription technology solutions segment.
The software side.
Yes. This is the aha moment for investors who think McKesson is just a physical supply chain. They have built a massive, high-margin software data fortress right in the middle of the healthcare system.
Okay, what does this software actually do?
Well, this segment isn't shipping drugs. It is processing the digital authorizations that allow the drugs to be dispensed and paid for. This past year alone, this software layer handled 3.4 million patient verifications.
Patient verifications, you mean prior authorizations?
Yes.
Like the friction at the pharmacy counter when you try to pick up a prescription, the pharmacist says, oh, we have to call your insurance company first.
That exact friction. McKesson's technology digitally connects over 50,000 pharmacies with 1 million providers and all the major pharmacy benefit managers.
Wow.
They sit right in the middle of that transaction. By automating the prior authorization process, they prevented an estimated 12 million prescriptions from being abandoned at the pharmacy counter this year due to affordability or authorization challenges.
12 million.
Yeah. They are providing the software workflow for 650 biopharma brands across almost every therapeutic area.
That fundamentally changes how you have to value this company.
It really does.
Because if GLP-1 volumes soften or if Rite Aid closes more stores, it certainly impacts the top-line revenue of the distribution business. But the actual earnings, the free cash flow, is insulated because it is being generated by independent oncology management and a digital verification software network.
Exactly. And that software operates at software-like margins, not distribution margins.
Which leads directly into what management is signaling with their fiscal 2027 guidance and their capital allocation strategy.
Right, because if you understand that they have successfully insulated their cash flow, the strategic moves they announced on this call suddenly look like masterclasses in capital structure optimization.
Totally. Let's look at the guidance. Management projects an adjusted EPS of $43.80 to $44.60 for FY27. That implies a 12 to 14% year-over-year earnings growth against a backdrop of only 5 to 9% revenue growth.
There is that operational leverage again, earning more on every dollar of new revenue.
But the most aggressive, complex move they discussed on this call is the Apollo deal.
Oh, this is fascinating.
Yeah, this is the carve-out of their medical surgical solutions segment. For anyone trying to model this stock, we need to break down exactly what this transaction is because it is not a standard sell-off.
No, it's very specific.
The transcript outlines that McKesson is spinning out its medical surgical segment into an independent capital structure. They signed an agreement with Apollo Funds, which is a massive private equity player who is buying a 13% minority interest in this unit.
Right.
And that purchase values the entire MedSurg unit at roughly $13 billion.
Okay, so to evaluate this, we really have to look at what the medical surgical segment actually does.
Right. How's it different from the main business?
Well, unlike the core pharmaceutical business, this division provides physical supplies to doctors' offices, surgery centers, and alternate site clinics.
Oh, like equipment.
Yeah. We were talking about bandages, syringes, exam gloves, and rapid testing kits. During the height of the pandemic, this division saw explosive, anomalous growth.
Naturally, with all the testing and PPE.
Exactly. But now, as healthcare utilization normalizes post-pandemic, the demand for these supplies has really flattened out. In the fourth quarter, this segment's revenue only grew 1%, and its operating profit actually decreased by 5%.
Okay, so it has become a slow growth anchor, weighing down the high growth metrics of the oncology and software divisions.
Basically, yeah.
So why not just sell the whole thing outright? Like, why do a complicated carve out where you only sell 13% to a private equity firm?
Because selling the entire unit outright incurs massive tax liabilities, and it fully detaches McKesson from a business that still generates significant cash, even if it is slow growing right now.
Ah, the tax implications.
Right. So by executing a minority carve-out with Apollo, they accomplish 3 highly strategic goals simultaneously.
Let's hear them.
First, the 13% sale establishes a hard public valuation of $13 billion for an asset the market was likely undervaluing.
Smart.
Second, they retain operating control and majority ownership, meaning they still consolidate the financial results and collect the cash flow.
Okay.
And third, they establish a standalone capital structure for this unit, allowing them to load it with its own debt.
This is where the financial engineering gets really fascinating to me. It is essentially a corporate finance maneuver to monetize an asset without losing control of it.
Exactly.
It's kind of like you take a slow-growing division, you bring in a private equity partner who specializes in optimizing these exact types of assets, perhaps prepping it for its own IPO down the line.
That's usually the private equity playbook.
Right. I think a good analogy here is it's like selling a minority stake in your guest house just so you can pay off your mortgage and own more of the main estate. That is a perfect way to look at it, because the most crucial part for you, the retail investor, is what McKesson is doing with the cash they pull out of this deal.
Right. They're aggressively returning it to the shareholder.
Yeah, very aggressively.
McKesson is issuing $2.25 billion in new term loans against that newly independent MedSurg capital structure. They are taking the cash from those loans, combining it with the cash Apollo paid for the 13% stake, and using it to fund a massive $5 billion share repurchase program for fiscal 2027.
Yeah, $5 billion.
Let's stress test that decision for a second. They are taking on $2.25 billion in new debt to buy back their own stock.
Right.
In an environment where interest rates are significantly higher than they were a few years ago, borrowing money just to reduce your share count sounds a lot like the dangerous financial engineering we saw prior to 2008.
A lot of people get nervous when they hear borrowing to buy back.
Exactly. How does the math on this actually create real value rather than just artificially inflating the EPS by shrinking the denominator? The math comes down to the spread between their cost of capital and their return on invested capital.
Okay.
This was specifically highlighted by their retiring CFO, Britt Vitalone. During the call, he cited that the company's return on invested capital, the ROIC, sits at a staggering 34%.
34% ROIC. For a physical distribution company.
Yeah.
I mean, that is software company territory.
It really is. It is elite capital efficiency.
Yeah.
So let's look at the arbitrage here. If McKesson can secure those term loans at an interest rate of, say, 6 or 7%, but their core operations are generating a 34% return on capital, borrowing that money is highly accretive.
Because the spread is so massive.
Exactly. Furthermore, they are projecting to generate between $4.5 and $4.9 billion in free cash flow next year. So they have an ocean of cash to comfortably service the interest payments on that new debt.
Right. It's not like they are strapped for cash.
Not at all. By using the debt to buy back $5 billion of stock, they're permanently retiring those shares. Every investor who holds the stock instantly owns a larger percentage of the company's future cash flows, and those cash flows are growing at double digits. It is a mathematically bulletproof strategy as long as the core business remains stable.
And speaking of Britt Vitalone, we definitely have to touch on the leadership transition mentioned in the transcript. The CFO is retiring after 20 years with the company.
Yeah, end of an era.
During the call, CEO Brian Tyler pointed out that during Vitalone's tenure as CFO, the company delivered a 500% increase in shareholder returns.
That equates to roughly a 20% compound annual growth rate over 2 decades, which is almost unheard of.
That kind of track record reflects a deeply ingrained institutional culture of financial discipline. This isn't a management team that chases top-line vanity metrics.
No. Just look at their actions over the past few years. They exited the European distribution business, they completed the Norway divestiture, and now they are spinning out the slower growth MedSurg business.
They are systematically trimming any operation that dilutes their margins.
Exactly. They are focusing every dollar of capital entirely on their highest margin, highest growth pillars, which are North American oncology, specialized biopharma distribution, and their technology solutions.
Which brings us to the ultimate question for you, the listener.
The bottom line.
Right. We have decoded the headline beats. We have unpacked the logistics of the GLP-1 boom and the margin expansion driven by AI and community oncology.
Yeah.
We have walked through the complex financial architecture of the Apollo carve-out and the $5 billion buyback. So based purely on the data, the operational metrics, and the strategic positioning revealed in this transcript, what is the definitive signal for a retail investor's portfolio?
The signal is overwhelmingly bullish. I mean, this transcript details a company operating at peak financial efficiency, successfully insulated from macroeconomic shocks, and aggressively leveraging its balance sheet to reward shareholders.
The thesis here really comes down to the concept of a pick and shovel play. If you look at the macro trends in healthcare, the explosion of GLP-1s, the advancement of personalized gene therapies, the proliferation of complex biologics, the market is booming. But trying to pick which specific biotech startup is going to successfully navigate FDA trials and invent the next blockbuster drug is an incredibly high-risk game.
It is clinical roulette.
Exactly. A drug fails a phase 3 trial, and the stock loses 60% of its value in pre-market trading. It happens all the time.
But the pick and shovel strategy removes that clinical risk. During a gold rush, the most reliable way to build wealth isn't panning for gold, It is selling the shovels, the pickaxes, and the tents to the miners.
Right.
McKesson is the ultimate pick and shovel play for the pharmaceutical gold rush. They take zero clinical risk. They don't spend billions on R&D hoping a molecule works.
To just ship it.
Regardless of whether Eli Lilly, Novo Nordisk, or an unknown biotech firm wins the market share war for the next generation of therapeutics, those physical molecules still have to be stored in cold chain facilities, routed through predictive AI networks, shipped to pharmacies, and digitally authorized by insurance companies. McKesson owns the infrastructure that makes that possible.
They are a toll bridge. And right now, they are telling you that traffic on the bridge is increasing. They have figured out how to operate the toll booths with AI to lower their costs. And they are using the massive profits from the tolls to buy back the shares of the bridge from you.
It's a brilliant cycle.
A company generating almost $5 billion in free cash flow and executing a $5 billion buyback is effectively building a concrete floor under its share price. For an investor, it represents a highly defensive, cash compounding fortress with the added upside of double-digit earnings growth.
And crucially, they are not starving their future to fund these buybacks.
Good point.
The transcript makes it clear they are continuing to aggressively deploy capital expenditures into the technologies that will protect their moat for the next decade.
Like what?
Well, they rolled out ambient AI scribe technology to 1,900 providers in their oncology network to reduce administrative burnout.
Oh, wow.
They are building more state-of-the-art robotic fulfillment centers. They are basically fortifying the ecosystem so that it becomes mathematically impossible for a manufacturer or a provider to operate outside of it.
Okay, we have dissected the mechanics of this massive earnings beat, but before we conclude this deep dive, I want to leave you with a final provocative thought.
Something to keep an eye on.
Yeah, something to consider that builds on the realities we've discussed today, but looks toward the horizon of the industry. McKesson has clearly built an empire. They are the indispensable infrastructure layer for North American healthcare.
Undeniably.
But as the entire landscape evolves, what happens if the major drug manufacturers decide they want to capture the margins that distributors are currently taking?
The direct-to-consumer threat.
Precisely. We have already seen the beginnings of this. Eli Lilly recently launched Lilly Direct, a platform designed to connect patients directly with independent telehealth providers and deliver weight loss drugs straight to the patient's home, bypassing the traditional wholesale distribution and retail pharmacy channels entirely.
It's a bold move by Lilly.
It is. If the manufacturers of the most in-demand, expensive therapeutics in the world decide to build their own direct-to-consumer pipelines to claw back those logistical margins, what happens to the toll bridge?
That is the multi-billion-dollar question.
Will McKesson's deeply entrenched digital verification software, their relationships with independent oncologists, and their sheer physical cold chain scale make them an untouchable necessity? Or could this sector eventually face the same kind of direct-to-consumer disruption that fundamentally broke traditional retail and media?
Something to watch very closely.
Just how impenetrable is this fortress when the people making the drugs decide they want to own the delivery trucks too? Keep that question in mind as you watch the healthcare landscape shift. Thank you for joining us on this exhaustive deep dive into McKesson's financials. Keep interrogating the numbers, always look for the underlying mechanics behind the corporate narrative, and we will see you on the next one.